Hi guys, welcome to Oliveboard. I am Abhishek Sharma. I am your faculty for Finance and Management. The topic of discussion today will be Basel norms. So let's start. So coming on to the Basel norms. You might have heard about things like Basel Accord or RBI has given this timeline for implementation of Basel norms. So what is the need of Basel norms or what is Basel norms? We'll come to that point later. First thing that we need to see is what was the need of Basel norms. I'll give you 2-3 examples via which you can understand this pretty easily. First one is, let's suppose a bank has given a loan to a power plant or for generation of electricity. Imagine that electricity generation plant runs into financial difficulties and it becomes a non-performing asset, that it is not giving any earning to bank. In that case, bank should have sufficient amount of capital so that the health of bank does not deteriorate. Okay. The first lesson that we can take out of this example is that in case something bad happens financially, in case your assets turn into NPA or non-performing asset, bank should have that extra cushion of capital to tide over this crisis or this episode. So first thing, the first lesson that we come to a conclusion is bank should have some extra cushion of capital. Second example that we can take is, let's suppose a bank in India, a large bank in India runs into a financial crisis. What happens after that? A large bank of India somehow runs into a crisis. This bank will have a ripple effect anywhere or everywhere in India. Why? Suppose a large bank fails, then all the investors that are related with the bank, all the depositors who are related with the bank, and there will be international repercussions also, because nowadays the global economy is linked. So if in a large economy like India and a large bank fails in India, it will have effects in all over the world. Remember the 2008 financial crisis, when the news came that the Lehman Brothers has failed, it had economic repercussions in the entire world. The share markets in entire world fell to the maximum that day. So these news of a bank running into financial crisis is now no longer limited to your geographical boundaries, to a national boundary. Rather, it has global impact. Okay. So first lesson that we arrived at, that banks need extra cushion of capital. Second lesson that we can take is that now the national boundaries are not that much relevant, and any failure in any banking system anywhere in the world will have global repercussions. Okay. So I have given you 2 examples. The third example is, let's suppose I am an investor. I want to invest in the bank that is offering me greatest interest rates. Let's suppose I am an investor based in Britain. Now, a bank in Pakistan is offering me 12% interest rate. A bank in India is offering me 8%. And a bank in US offers me 4% of interest rate. So where should I invest my money? Where should I go? If you see this problem in a simpler terms, you will say, okay, Pakistan is offering you 12%, so let's go to Pakistan, invest there. But nobody is going to tell me what is the risk associated with Pakistan, why they are offering this much interest rate. So what the Basel norms help you here in this case, help the investors, that it prescribes a common standards. It prescribes a common standards or common capital requirement for banks across the world, so that I am at least assured that, okay, all banks are following Basel norms. So wherever I am getting better returns, I can go there. Okay. So first thing, again I am repeating, to a bank should have an extra cushion of capital. No longer banks are limited to the national boundaries. They are now, any bank runs into financial crisis, it has a ripple effect across the world. And the third one that we came to a conclusion is, banks should have certain standards which are followed by entire world. So for these 3, now we are coming to Basel norms. Why Basel norms are needed? Basel norms is nothing. It is, as you can see, the Basel stands for a city in Switzerland, which is the headquarter of Bureau of International Settlements. This Bureau of International Settlements, what it does, it has all the central banks of major economies, and it ensures that financial stability is maintained into the global economy. So it is nothing but it is onboarding of central banks of various countries to ensure financial stability. Okay. And the Basel Accord, now you'll say, okay, we are clear with what BIS is. What is Basel Accord? The thing that we see in newspaper, almost in a month at least you will see a description of Basel Accord. And in economic times, you will see it almost 8 to 9 days, you will see this. So what is this Basel Accords? So Basel Accords is nothing. This BIS releases some guidelines, which are nothing but some supervisory guidelines. And by these groups of central bank who are on BIS, there is a committee which is known as Basel Committee on Banking Supervision. So the agreement, the guidelines which are released by this committee and agreed by the constituent central banks is called Basel Accords or Basel norms, which is the topic of discussion today. All right. So Basel guidelines by the groups of which is known as Basel Committee on Banking Supervision or BCBS, and the set of agreement that is there by BCBS is called Basel norms or Basel Accord. So clear why Basel norms was needed? What is Basel norms? What is Basel? It's nothing but a city in Switzerland, and so the basics must be very clear. Now we'll move towards certain terms, certain terminologies that are generally associated with Basel norms. This is important because before we move to the core Basel norms, we should at least have the idea of certain terms that I am going to use later in the later part of the video. Okay, so understood? Clear? Okay, so friends, before we move to the main Basel Accord or the main Basel norms, I want you to understand a few terms, a few terminologies that you will be using. So the first thing that you can see on your screen is risk-weighted asset. What is asset in general? What is asset for, suppose you are a working guy, what is asset for you? Anything which generates income is called asset. Now tell me what is asset for you. So asset for a working guy is the labor that he is putting. If he is working in a bank, the labor that he is putting in the bank, he gets salary in return. So the labor generates salary for him. So labor is an asset. Suppose I have a company. I am the owner of a company. So the company is an asset for me because at the end I am getting my income via that company. Alright. Similarly, come to the opposite of asset, that is liability. What is liability for an individual? What is liability for an individual? Let's say I have a car loan and I have a housing loan. I have to pay money. So that is liability. Anything that sucks money out of you is liability. Anything that provides you money is asset. The difference is clear? Now, take these two terms for a bank. Now think, what should be the asset for a bank? Asset for a bank is something that again generates income for the bank. What generates income for bank? The loan that bank gives. Because via loan, the bank gets interest. So loans are asset for the bank. And what is liability for the bank? The deposits that you are making. Suppose you have applied for a fixed deposit. Now bank has to pay interest on that now. So that now turns into liability for bank. That fixed deposit is asset for you. Remember this thing. Fixed deposit is asset for you, but fixed deposit is liability for the bank. So it just reversed. The role get reversed. Now coming on to risk-weighted asset. I'll just give you an example. It will be very clear. Okay, you see a car and a robot on your screen. Don't worry, this is just part of the example that I'm putting. Suppose a bank gives a car loan of say 10 lakh rupees. So bank give a car loan of 10 lakh rupees. And another college pass outs came and they said we want to launch a startup which is based on robotics. Okay, some college pass out students came and they say we want to launch a startup, it is based on robotics, so please give us loan. So bank said okay, I'll give you 50 lakhs of loan. Now in this loan of 10 lakh rupees, what is security? The car is security. And 50 lakh rupees, what is security? It's nothing. Building might be a security, but it's nothing but the idea of the owners, the idea of robotics in that startup. Which loan is more riskier for the bank? Car loan or robotics? The robotics startup loan. See, in car loan, bank have security in form of car. And if the person who is applied for car loan is a salaried person, then the bank can put hold on his salary which is crediting into the bank. So they have two options. The salary which is coming as well as you have collateral in form of car. Robotic startup does not have that. So it is more riskier proposition for bank. So let's say bank says okay, the risk that this loan will default is say, the risk that I can associate with this loan is 20%. This is more riskier, so let's say bank assigns 80% risk to this because it is a riskier proposition. All right. Now, what are the assets for the bank? These are loans now. Asset is car loan and robotics loan. Now, risk weighted asset is nothing but when you multiply the asset with the risk percentage. That is risk weighted asset. What is risk weighted asset here is 2 lakh. In this case, 40 lakh. This is risk weighted asset or RWA. I'll be using RWA now onwards. So risk weighted asset here is 2 lakhs and in case total risk weighted asset is now 42 lakhs. So this is clear. What is the total risk weighted asset? 42 lakhs. What are the total assets of the bank? 10 plus 50, 60 lakhs. So the total asset of the bank is 60 lakh and the risk weighted asset is 42 lakhs. So this will be more of use in this video, risk weighted asset. So risk weighted asset is clear. Now we'll move to the next term, capital adequacy ratio. This is more famous term that is used in Basel norms. What is capital adequacy ratio? As you can see, it's a measure of bank's capital in terms of risk weighted assets. Okay. So what were the risk weighted asset of the bank that we just discussed? It is 42 lakhs. All right. Let's suppose the bank's capital for this bank is 4.2 lakhs. Okay. The capital for this bank is 4.2 lakhs. So what is capital adequacy ratio or CRAR, capital to risk weighted assets ratio? So CRAR is nothing but the bank's capital upon risk weighted assets. In this case, 4.2 upon 42, which is 10%. Okay. So the capital adequacy ratio or CRAR in this is 10%. This is used to protect the depositors and ensure financial stability. How does it that? It prescribes a capital adequacy ratio in such case that banks have sufficient capital. I gave you an example. Remember that at the start of the video, I gave you an example about that bank should have extra cushion of capital. The conclusion was this. Similarly, capital adequacy ratio, what it seeks to ensure is that bank should have that extra cushion of capital. We'll see how much is applicable for Indian banks right now later on. Okay. So now next term is tier 1 capital or core capital of the bank. You are aware of the term liquidity. Liquidity means how easily you can convert a certain thing, an asset, into cash. Cash is obviously 100% liquid. You have cash, then that is 100% liquid. If you go for a gold is slightly less liquid because you have to go to a jeweler or you have to go to a bank and apply for a gold loan. So similarly, gold is less liquid. It takes time. So gold is less liquid than cash. The third is land. Suppose you immediately need a cash, then you have to sell the land. You need to find a buyer for that land. So land is the least liquid. So tier 1 capital is something which is the most liquid, which can easily be turned into cash, right? It includes paid up capital, that is the common shares of the bank. All right. Second, statutory reserves, what it means? It means that what banks does, they will put certain percentage of the retained earnings or the net profits into these kind of reserves. So these can be used against any investment loss that might happen or to buy new assets. Okay, in case of industries. So these reserves are basically nothing but the bank putting aside certain percentage of their retained earnings. Okay, so these reserves. Then capital reserves. These arises from sale of assets. Suppose bank go for a securitization, bank converts our housing loan into a security. So these kind of reserves that banks need for purchasing of long-term assets or selling the current assets, the money that goes into that is known as capital reserves. So these three reserves are more liquid and they are easily accessible. So this is called tier 1 capital. It is one of the purest form of capital that is available with the bank. Okay. So friends, this concludes our topic of Basel norms. For more such videos and live classes, join our RBI Grade B Cracker course.